This is Macro Analytics, delivering frank conversations on global macroeconomics and market analysis outside the mainstream, featuring discussions and debates between Gordon T. Long, publisher and editor of GordonTLong.com, and his guests. The content of this discussion is strictly the opinion of the participants. It is in no way a solicitation for business, nor is it to be considered investment advice of any sort. Always consult a registered investment advisor before making any investment decision. These discussions are extremely hard-hitting and terribly frank, and parental discretion is advised. Now, on to the show.
Good morning. I'm Gordon Long with GordonTLong.com, and I have with me this morning a couple of noted and well-recognized financial authorities and writers on the web. No stranger to our regular listeners is Ty Andros, the president of TraderView, publisher of the TedBits website, and writer and editor of a very well-recognized newsletter also named TedBits. Joining us today for the first time is Axel Merk from the West Coast. Axel is the founder, president, and chief investment officer of Merk Investments. He's a frequent financial speaker, web contributor, and author. Welcome, everyone.
Thank you. Great to be with you.
Yes, thank you.
Axel, I'm sure some of our listeners may be unfamiliar with your work, so let's begin by you giving our listeners a perspective on your background, writings, and Merk Investments.
Well, sure. Yes, thanks for that introduction. And when you see on the slide here, dollar, currencies, and gold, I'm not going to talk about the latest carry trade strategy in currencies. What we do is we look at the world, and our view is that we may not like what our policymakers are up to. But if you study in depth what our central bankers, be it Bernanke, Draghi, or Kuroda, or our politicians from Obama, Merkel, Abe, or whoever it may be up to, we think they're quite predictable. And we think that the place to express those views may well be the currency market. And so by expressing those views in the currency market, you're not taking on equity risk, and you're not taking on interest rate risk. People always think currencies are also very speculative. But when you think about the euro moving a cent from 133 to 134 or so, well, on a percentage basis, it's a small move. And so what we do is we do fundamental research on a macro level. We study central banks inside out. We go into depth on a macro level and devise our views from that. And then what we do with that is, first of all, we do manage mutual funds. So we manage money. We have two mutual funds if you think that we have the better printing press than the rest of the world has. We have one mutual fund if you think there are currency wars and there's a way to stay a step ahead of the game. And then we have one product that's a tad more complex. But importantly, one of the things we do is we reach out to the public for dialogue. And we publish a newsletter called Merk Insights. We publish white papers. We talk a lot with business leaders. We talk a lot with central bankers as well. Or we engage folks like Tom Keene on Bloomberg Radio, or in this case, obviously, Gordon and Ty, we chat with. And the reason we love engaging people is because we get a lot of feedback. When we get feedback, our idea generation process gets enriched. And through that, we don't think we're the smartest guys in the room. But what we think is that if we can build a consistent framework at which to look at the world, we can derive investment decisions in the world of currencies that might make money. And so that's the space we're in, and in a nutshell, that's who we are.
Ty and I asked Axel to join us this morning because whether we're talking currency wars, the U.S. dollar and its status as the world's reserve currency, the euro, or what's going on right now, this Asian and emerging markets currency drops, Axel is obviously the person to talk to. And as it says right on Merk's masthead here, they are the authority on currencies. Axel's brought some slides to allow us to cover as much territory as possible in the limited time available here this morning. And we're going to talk about the dollar, currencies, and gold. And we're going to do it in terms of geography, the U.S., developed markets, and then Asia and emerging markets. Before I turn it over to you, Axel, I know, Ty, you had some observations you wanted to share about the challenges Axel and Merk face on a daily basis.
Actually, when it comes to absolute return investing, Axel probably has one of the most challenging jobs on the planet because he's got to be dealing with huge cash flows around the world. I'll call them fire hoses of hot money. And they're fire hoses of hot money because there's really too many dollars for the amount of I'll call it returns from real assets. And on top of that, he's also actually having to run a beauty contest to see in relative terms where that money may be flowing. And the statistics that the government give to Axel are politically correct, but probably quite practically incorrect. And so it's our pleasure to have Axel, and of course our regular listeners know that I'm a hardcore Austrian, and so I'll be hopefully bringing a few thought-provoking ideas to the table today as we really explore the insanity that's going on and the challenges in making money, and we all try to do the best we can, and I'm glad to be part of this today. Thank you for inviting me.
Thanks, Ty. Can I just make a brief comment here on what you said? Is we do have two products that are more directional, and then one that's specifically on the absolute return space. And one of the observations that we have made is that many absolute return strategies have been struggling. Ours used to as well. And the reason is that many absolute return strategies are very quant-driven. And the challenge is, no matter how great your backtesting is, when policymakers are very actively engaged in the markets, or when they change the rules along the way, well, your quant model is going to break down. And so we took that to heart, and in our own absolute return model, what we decided to do is, instead of being so much reliant on too much on quant, we devised ways to deploy our macro views in a systematic way onto our space. In our case, it's the currency space. And with that, we have the human touch in there. We have the human element in there. And then you talk about firehouses around the world and so forth. And the nice thing about the currency space is it actually reacts very slowly. Somebody prints more money than the other guy does, and it takes a long time until that's reflected in the market. And so we think the opportunities, but yes, of course, the markets, not just our market, all markets are intended to exert the maximum frustration onto investors, and managers, of course, all the same. And so you got to have a thick skin in this market, by all means.
For some of our listeners who may be joining us for the first time and don't know Ty's background, I need to mention that Ty is really a currency repair expert. His job and what he spends his time doing is restoring the function of money. Is that fair, Ty?
Yes, I believe actually we live in interesting times, as they say in China, but great danger is equal to great opportunity, and I hope to be at the front of the receiving end rather than the losing end.
Axel, I have your first chart up.
Sure. Let's talk about the value of the dollar, obviously, because ultimately when we talk about currencies, it's all relative to the US dollar for US-based investors. And currencies throughout the world, and the dollar in particular, is at risk of losing its function as a store of value. And we like to work with cartoons because they express our thoughts in a very concise manner. The trouble is, there is no safe haven anymore in this world. And clearly many people, including us, believe that gold might ultimately preserve one's purchasing power better than many other things. But still, when your daily living expenses are in one currency, be that the US dollar, the value of gold fluctuates. And we have been moving further and further away from the gold standard over the past 100 years. We see no reason why that trend shouldn't continue, more likely even to accelerate. And so as an investor, what that means is that you should throw out that risk-free component in your portfolio. That doesn't mean you have to become a day trader, but it means you have to embrace that there is no place to hide. You can do what the Chinese are doing, diversify to a basket of currencies, or just go for very risky assets because you want to ultimately preserve your purchasing power, or in a world where there's a lot of turmoil, find other ways to diversify. Clearly, as this cartoon points out here, our policymakers want to make us believe that the dollar is a store of value, but with the negative real interest rates we have, even if one believes the government statistics, the purchasing power of the dollar is at risk as much as most other things are at risk these days.
Axel, is there anybody in the world that is still based on a gold standard? I can't think of one.
Nobody that matters. There is once in a while a story out that some tiny country is moving towards the gold standard or this or that, but nothing really that matters and is accessible from an investor's point of view, from a US-based investor.
So store of value is a global issue.
Of course.
Ty?
Axel, what are your intermediate term views? That's interesting that you think that we are going to now, for the first time in history, really transition to fiat currencies forever. And as an Austrian, I, um, hold some fairly heavy views about paper and their lifetimes, and you don't think that at some point this monetary system and the financial system will be crushed under the weights of these things that have been emerging?
It might, but my view is that don't trust the government of taking care of your purchasing power for you. If you think precious metals are going to retain your purchasing power better, well, then buy your own gold. Don't think that your government will take care of it for you. Governments have shown a very good ability to kick the can down the road with various unintended or partially intended consequences. And so it's quite possible, of course, that at some point some countries will come to their senses, but certainly not voluntarily so. And so in that sense, we may prefer one system over the other, but ultimately we have to embrace reality. And the reality is that we are in an increasingly unstable world, and we have to deal with that. And so if you're interested in a gold standard, then have your personal gold standard. And I personally have a substantial portion of my personal assets in gold. But I don't think any of the major economies are at any time going to, in the near future, embrace a gold standard.
Axel, I don't want to get us off track at all, but I know for a fact a lot of our listeners are grappling with, the amount of gold that China is now buying, which is just astounding, maybe as high as 1,800 tons annualized rate. We well know how many ounces that Russia has been buying. They're now 10% of the reserves in gold. And is there a possibility that they're going to, at some point, gold back, whether it's going to be the renminbi or the ruble or some other alternative, to actually create an alternative reserve currency? Is there a possibility of that, or is that just fiction?
Well, whenever we look at what's happened in the world, we look at the world in terms of scenarios and look at certain probabilities. And then if they are reasonably high, then we're going to do something about it. Now, as far as the Chinese are concerned, I'm sure that's a possibility, but at the same time, while the Chinese have been increasing their gold holdings, their reserves are accumulating at such a fast pace. And generally speaking, central banks are try to be prudent players in the markets, that they're not able to buy enough gold that as a percentage of the total reserve, it's able to increase. Now, can it change? Sure, it can change. But generally speaking, these players don't want to push the prices around too much. And so, of course, on the margin, they will affect the prices. Can they switch gears? Sure. But for now, the primary goal of the Chinese is they want to have their currency in order to compete as a world reserve currency. They need to do more than either link the price to gold or create a floating currency. They need to do all kinds of things. And many of the steps they have been taking, they need to foster domestic income markets. They need to develop an offshore fixed income markets. They need to increase their regulatory environment. They need to increase competition in the banking system. They need to open up the system from the ground up. You cannot just become the world's reserve currency overnight. It took the U.S. decades to gain that status, so to speak. And the Chinese are taking all these steps, but these are mini steps. We are unlikely going to wake up tomorrow where the world is completely different. Just like the Europeans are not going to wake up tomorrow and sign a new treaty. The way that these societies change is gradually over time. Now, clearly, you can have a shock and then something can happen as part of a shock. That's always a possibility. But I would be reluctant to say, hey, tomorrow China is going to back everything they do by gold. They don't. Everybody loves to have the printing press to be able to bail out everybody if the need arises. And the Chinese are no different in that. The Chinese just have been more prudent and have been moving in the right direction, whereas most others have been moving in the wrong direction.
Didn't mean to get us off track. Thank you, Axel.
The slide we have here is just a brief comment here on the drop we have in gold, especially in April. A couple of comments I'd like to make about that. One is most folks that didn't like gold before the correction still don't like it. Most folks that liked it before still like it. And so the only thing that changed is the price, well, you should like it more. But more importantly, especially the sharp drop we had in April, is a result that when something goes up for 12 years in a row, well, people use leverage. And, that at some point has to have at least an interruption. And so at some point somebody decided to take a profit and there were no bids in there. The relevance here is that this can happen in any market, especially in the S&P as well. In 1987, we had portfolio insurance where investors thought they were protected by hedging their investments with derivatives. Nowadays, investors think they don't need derivatives anymore because you can trade in a nanosecond. Well, I wouldn't be surprised if one day somebody decides to take a profit in the market, and guess what? There's not going to be any bid around. And so this is just a warning that any market can be rather brutal, including the gold market. Now, clearly in gold, we have the separation or the fiat market, so to speak, and the physical market. But as we've seen, these fiat markets can yank prices around. And it is intended to be a frustrating world when it comes to investing, and gold is no different in that. And you've got to have good nerves. Gold is historically volatile, and it will always be volatile when priced in US dollars. And so even if you believe that you should have a substantial portion of your assets in gold, as I do, you've got to be able to sleep with your investments at night. If you can't, then you're overinvested.
Axel, I've been in gold for consistently for over 25 years, and one of the many things that I have learned is if you haven't got the stomach to take a 25% move, and it will happen down, then you shouldn't be in the market, because you will see that kind of volatility. You can do well on it, but it's not for the faint of heart. And more so, I think, today than ever before. I think that the moves are getting even more aggressive. Would you agree with that, Ty?
Yes. I actually believe we've been going through, I'll call it a kind of an apocryphal correction, very rare over the last 4 or 5 decades. There's lots of what I'll call elephants in the room, changing how they are positioning themselves. A lot of that sell-off in gold, in my mind, was due to a big run on the bullion banks and a big drawdown in those reserves. And we really don't know who took those reserves down and where they've been sent. And did it rotate east? A high probability. But I believe we're in I'll call it the bull market to end all bull markets. Axel, I actually believe that we're in the early stages, or the beginning stages, of a currency and financial system extinction event. And that gold and silver have been money for 3,000 years, and they were around before the dollar was born, and they'll be around after the dollar's over. And that the banking systems are running wild, and of course the BIS, they have more gold than any of us can even imagine. It's very clear that a lot of the gold over the last decade has rotated to those vaults in Switzerland, and that we're just in a period of high turmoil. That gold is going to be what it's always been before it's over. I, like you, Axel, keep a substantial amount of my net worth in gold and silver, and as you said, I was friendly to it before, and I'm still friendly to it. But the challenges are great. It's actually, I believe that what we're going through now, Gord, as you well know, is going to be written about for centuries.
The only nuance I may want to add to that is that we're not going to have another Bretton Woods where policymakers throughout the world come together and decide on a new world order. The Europeans can't even agree on anything. How can you get policymakers from China, from Europe, the US, Japan, get together? Somebody wants more liquidity, somebody wants more price stability, and so forth. And so while I agree with you that a bunch of currencies are going to go bust at some point, they're going to replace it with something else. They'll call it something else, but policymakers will always try to find a way to find a way to tax people through inflation or otherwise through default. And clearly, those that own gold might be better off than many others are in that process. And so, yes, of course, gold is going to be around in a few thousand years, and the other currencies we deal with may not be around. But it's just the one thing I like to just caution people is when you talk about the extinction of currencies, some people may interpret that as saying, all right, then some other power will come in and be a benevolent dictator who's going to tell everybody what to do. My view is that the opposite is happening. When we have that sort of crisis, we end up in chaos. And so clearly gold is going to survive that, but that means we're going to destroy the social fabric of people, and we're going to have less order rather than new order as we're moving forward.
Yeah, and I guess I would say that, a lot of people are looking for the death of the dollar, but I don't believe the dollar. I believe the dollar is going to be the last to fall because, there's two constituencies there. And there's the constituencies that are printing it endlessly and the other ones that are trying to store wealth in it. And really, it's, kind of a leviathan among reserve currencies. Where do you run? And you'd run to just some other, I'll call it a challenge sovereign. And, people say, oh, well, we're going to go to a world currency. I would beg to differ as well, Axel. I agree with you that politicians aren't going to give up the prerogative of inflating and stealing their constituents' wealth through printing. And so, anybody that looks at Europe knows what happens when you give away the privilege of seigniorage. And I don't believe people will make that mistake the next time. It's really now just turned into more of an exercise of gathering political power in exchange for having the printing press. And the euro to me is the only word. It's a nightmare because it's not really backed by a tax base, and it's not backed by an army. And if something, obviously if 60% of global bank reserves are held in dollar-denominated assets, and there's about to be a failure of a currency auction, they just will call up another central bank and say, hey, what you're trying to store that wealth in, tomorrow morning it really kind of is going to crash. They will print up the money, buy the bonds, and call it an asset. And so, we're really in a very interesting game right here. And, it's really challenging. Like I said, Axel, you have the toughest job in the world.
Yeah, sure. And as we move through these slides here, I'll be glad to talk more about the euro. The flip side of that is, of course, that structurally it is far more difficult to debase the euro than it is to debase the dollar, because precisely the individual central banks within the eurozone can't print their own money, and so the dynamics are different. And ultimately, yes, there is no risk-free asset. What we see here is the central bank balance sheet chart, and that shows in relative terms, relative to 2008, how much money has been printed throughout the world. Bank of England and the Swiss National Bank, as a percentage of the starting point, have printed more money than the Fed has. The quote-unquote good guys are the Australians that have actually, on a net basis, not printed money. On the reddish line, I'll be glad to talk about Japan here. Their printing press is only getting going. But the one line that most people may not be familiar with is the European Central Bank. That's the darkish line hovering in the bottom, then moving up to in late 2011. In late 2011, Mario Draghi became the head of the European Central Bank, provided that 3-year liquidity operation. But if you look to the right-hand side, their balance sheet is coming down. And so while we talk about tapering in the US, while the Europeans are not only tapering, they're mopping up liquidity. And not voluntarily so. The European Central Bank is far more demand-driven. When a bank needs liquidity, they knock on the door of the European Central Bank. In this case, they get unlimited liquidity. But they can pay these loans back early now. This 3-year facility, they are able to pay back early, and the banks don't want the money. And so the Europeans are actually mopping up liquidity. And we can complain about many of the things that are dysfunctional in Europe all we want. But ultimately, here are the guys who are actually very restrictive in the monetary policy. And surprise, surprise, the euro has been surprising many on the upside. And so that's just some thought I want to give to people, that as much as people just think they're baffled about how Europe can function the way it is, if you look at the value of the currency, I'll be glad to give other reasons why the euro has been much stronger than many people have been anticipating.
How do you expect them, Axel, to ultimately deal with the insolvency of the financial systems and the sovereigns? I mean, the reason that the banking systems in Europe are really sustained is because that's the only way they can get a commercial bank to print money for the sovereigns. But how do you expect that to play out in the intermediate to long term?
Well, a couple of things. If you look at it from different perspectives, if you look at it from a government point of view first, before we talk about the banking side, the reason why sovereign defaults happen very late after a very tough process, look at Greece, for example, is because you can write down your debt once you have a primary surplus. As long as you have a primary surplus being before paying your interest expense, you want to be in the black. Because if you have a deficit before even paying your interest expense, if you were to default on your debt, nobody is going to give you any reasonable funding the day after you default, which means the shock of the economy is going to be brutal. And at the same time, if you just have to whine a little bit to the European community and to the ECB and to the IMF and you get billions, well, that's the path of least resistance. But once you have a primary surplus, you're holding the strong end of the bargain, because you can say, hey, I'm going to default on my debt because I don't need you guys anymore. I'm going to get a clean slate. And so that's one reason why these things take a long time. Now, from the European Central Bank point of view, any central bank, the Fed, the ECB, Bank of Japan, any others, can keep a zombie banking system alive. We saw that in the 90s in Japan. We saw it in 2008 in the US. We saw it in the Eurozone. What a central bank can do is they can buy time. Now, the reason why central banks want to buy time is because they want to help banks to recapitalize themselves, to raise more capital. They can do it like in the US, where they actually go out in the market to raise more capital. They can do it a very unfortunate way that it's very much done in Europe, where the European Central Bank is charging only 1% for the loans that they're offering, and then the banks can go out into the market and give riskier loans, including lending money to their own sovereigns, and they can the spread they're taking here is a profit to their bottom line. And so many of the banks are actually in much better shape than they have been. And so if you look at whenever a crisis has been flaring up of late in the Eurozone, take the Cyprus example. A couple of days after the peak of the Cyprus debacle, Spain had a treasury auction where the yields they paid were the lowest since the early 90s. So what that signals is that this market has moved on. In any crisis, initially, you have a wholesale selling of everything, meaning in this case, the euro. We argued very strongly when the euro was diving towards 118 a couple of years ago that these spreads, that these issues are very serious, very real, but they ought to be expressed in the spreads in the bond market, and the euro itself can be reasonably strong. Then, of course, what happened is that the policymakers were running in all kinds of directions. And when you don't know where management is taking a business to, you cannot price that risk. And then what happened a little over a year ago, after Draghi gave his speech, he'll do whatever it takes, he imposed the process on the Eurozone. And ever since then, things have been calming down. And the reason is that there was a process in place, maybe not a very good one, but people were able to price these risks. And so what's happening now is that when you have a crisis, it is priced locally. So let me just make a parallel here before getting too complicated. In the US, we have bank failures all the time, but we don't have a currency crisis every time a bank is failing. And that is because we know the process of how these banks are being wound up. Now, clearly, lots of things are a mess in Europe, but still, we kind of know how this mess is being dealt with. And so ultimately, my vision is that what's going to happen is we're going to morph forward. We're not going to have any quote-unquote solution, but what is happening is that the banking system will be strong enough to stomach the restructurings of select sovereigns. And so as Spain, for example, needs to restructure some of its debt, the banking system there needs to shrink. The local bureaucrats are too protective of the banking system. That's one of the reasons why they're moving more towards the central regulators. But the market is embracing the idea that the banks will be able to handle restructuring of the debt. And ultimately, if you think about it, you can handle with too much debt in a number of ways. You can deal with it with default. You can deal with it with inflation. You can deal with it with paying off your debt, or with outgrowing your economy. The latter two are very difficult, if not impossible, to take place in most of the developed world.
Or confiscating the depositor's money.
Well, clearly, but if you think about it,
in Cyprus, isn't the LTRO, and correct me if I'm wrong, but the European banks when they borrow money against assets, the ECB inserts themselves in the capital structure ahead of all creditors, including the banks. And so that the reason that Cyprus had to turn to the depositors was because all of the assets had been borrowed against with the ECB, and they just took the assets back when they failed. Am I wrong?
Well, that's a bit too simplistic. It's not the ECB's fault that Cyprus is a mess. I mean, the Cyprus mess is their own doing.
No, but they took the main assets because
if you put your money into a separate bank account, you were getting yields of 5 to 8%. And surprise, surprise, that wasn't risk-free. The money in Cyprus, to a great extent, was money by Russians. Their money wasn't welcome anywhere. The Cypriots, they loved that money. And in Cyprus, they decided that, they're gonna use those deposits to gamble in the financial markets around the world. And then obviously, yes, they went to the European Central Bank because they weren't able to access any interbank lending markets, to refinance themselves. That is not the fault of the ECB. You can say, all right, you're never going to provide any funding access, but if you're getting all your capital to play with from your depositors, sure, there's something going to give. But let me make a broader point here. Mr. Dijsselbloem, the guy, the head of the Eurogroup with his unpronounceable name, he was quoted in the press as saying that Cyprus should be a model for the Eurozone. And he was new at his job. He got his foot in his mouth there a little bit. But then he clarified his comments later on, and he actually meant what he said. And more specifically is that the risk should be priced where it originates. What a novel concept, right? And clearly, if you provide an FDIC-style insurance, you should be protecting those insurance if you provide the guarantee, and you shouldn't go under the small depositors. Ultimately, if you're a true Austrian, hey, if you lend your money to a bank, well, yes, it's at risk and you can lose your money. The challenge here always is, the rules of the game must be known ahead of the time if you want to be able to price your risk. And you destroy confidence when you change the rules. But the very concept, just let me finish this thought, the very concept that if you put your money into a financial institution, that it is at risk is the only right concept. And we need to go back there. The problem is when you have these guarantees, these blanket guarantees, everything is safe until the guarantor fails, in which case everything breaks. The reason why the U.S. financial markets are more robust than other markets are because they're diverse. And when you have a crisis in one segment, you tend not to have the contagion to the other segments. And clearly, we can talk about why there's contagion anyway and so forth, but the principle that the risk is priced where it originates is absolutely the right risk, the right principle, and Europe is moving in that direction. And that is one of the key reasons why the financial markets have been quieting down in Europe. That doesn't mean you won't have sovereign defaults. But to just wrap up this idea, just because there's a crisis in a Eurozone country doesn't mean that the euro has to be weak. Those have to be separate concepts. You can have Italian bonds under distress, yet have the euro be strong, because a euro is not the same thing as the other euro. It matters whether you hold a German T-bill, a Spanish T-bill, or a euro bank deposit with Citibank. And same in the US, by the way. A US money market fund is not the same as a T-bill as a deposit with your local credit union.
Ty, I'm going to ask you just to hold your comment because I know you want to respond. Axel, we are up against our hard line here. Could you give us some more time?
Of course.
Okay, we're going to be right back with the second part 2.
This has been Gordon T. Long, editor and publisher of GordonTLong.com. New recordings are posted regularly and can be found at GordonTLong.com. New show notifications are available through RSS feed, iTunes, and other social networking venues at GordonTLong.com.